As our next guest says, if the economic slowdown is real, it will likely allow the rate-cutting cycle to begin. It also raises concerns about earnings growth, though. This is exactly the conversation to have. What's it mean for your portfolio? Let's bring in Jim Tierney. He's the CIO of Concentrated U.S. Growth with AllianceBernstein. Jim, I think you summed it up aptly. So which way are we headed here?
I think we have to see earnings start to slow. The market's cheering slower economic growth. That will ultimately have an impact on earnings estimates. The growth numbers this year and next are double digits, and I think that's just too high for the overall market in terms of earnings growth.
So if that's the let's put it differently. When I spoke last hour with one of our Margie Patel investors, she said, look, if we can just muddle through with 1.5% real GDP growth like we've done probably in the first half of this year, stocks can still go up in that environment. Why do you disagree?
I don't disagree that stocks can go up. What I would say is that overall earnings estimates that have been incredibly robust, that haven't revised down at all this year, probably have some downward revisions. Those that have bigger revisions probably don't go up. Those that don't go down quite as much or don't go down at all keep on going higher in terms of their stock prices.
So it would appear to me, if I deduce correctly from your thesis there, Jim, that what the kinds of companies I ought to invest in are very stable companies with very stable, if modestly growing income streams, and maybe a dividend. What do you say, and what names would you mention?
I guess I'd tweak that a little bit. I want to see robust secular growth. But in that world, I think Zoetis is a great example. It is animal health, where we have more companion animals, we are eating more protein around the world. They treat both classes of animals. So that's a stable grower, but really a robust grower. And their PE has come down, their relative multiple has come down quite a bit. Another example would be American Tower. We're not going to be using our cell phones less. If anything, we're going to be using more data. That's a company that's been pressured by higher rates. If rates come down a little bit here, I think you get a multiple expansion or re-rating there. That's a company that's 35% below its 5-year average PE. And then Cooper Companies, they reported last week. Great quarter. They revised their full-year guidance higher, and the stock really didn't do a whole lot. Some of the headwinds have been the strong dollar and certainly higher rates, but the underlying business fundamentals are beautiful there. And again, another double-digit grower. So I don't think you have to compromise on growth. I think there are plenty of examples of companies that have been hurt by higher rates, and if rates roll over a little bit here, they get a tailwind in addition to their great underlying fundamentals.
Mike Santoli, do you think the market is moving towards pricing in much greater odds of a rate cut in the near term? And if so, what is that likely to mean? To go back to the Michael Hartnett expression of typically, as investors, you want to sell the first cut, but a lot of people think this time might be different.
Yeah, I think the market is incrementally more confident after, let's say, the last 2 or 3 days of numbers that we will get perhaps a better chance of, let's say, 2 rate cuts this year. That's what you're seeing in the September rate cut pricing. I don't know if it's as simple as saying, you like to enjoy the pause between, the rate hikes and the cuts, but you sell the first cut. I go back to 1995. You didn't want to sell that first cut. There were only, I think, 2 that year, maybe 3. And it was spread out very far. And nobody really cared because that wasn't seen to be the driver of things. So I think there are enough exceptions if we're going to be in that fairway of soft landing where, inflation and growth both remain in these tolerable areas, then I don't think that it's some kind of a magic contrary signal that the Fed cuts. I do think, though, that, Kelly, the market this week was evidencing some concern that the Fed had its eye off the ball and was going to sort of be a little bit too cute about it and end up being late. I don't know that today the services numbers, fit with that thesis that things are falling apart in the economy.
Jim, what do you think? We had someone on last week who said the question really is which cracks first, the economy or inflation?
I think they're both coming down, quite frankly. They're relatively well behaved and to a degree fairly tied. I do think that you're going to have to differentiate between what companies in a slower growth nominal GDP environment can still grow at the expected levels. And it's not going to be everybody. Investors haven't been quite as discerning about earnings growth this year. I think that's going to be the second half story.